Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers to bring you this webinar today on simple option strategies. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and our sister company, InvestTrade. A few housekeeping matters. The session today will last approximately 1 hour. We ask that you take a moment now to locate the Q&A box on your screen. Please enter any and all of your questions here throughout the webinar, and our speaker will answer them at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer options trading, and we enjoy teaching people like you how to trade them. We offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform as well as free trading tools to help you spot those trading opportunities. Our parent company, Regal Securities, has been proudly servicing investors since 1976. Also, a recording of this video will be available on eOption's YouTube channel in the next few days, along with our extensive library of trading videos. So we encourage you to take a moment right now and subscribe today. And as a bonus, we will have a free stock offering on our YouTube channel. It'll be in the description under this webinar when we post it. So we encourage you to subscribe to YouTube so you don't miss that. That will only be available for a limited time, and we'll give you some free stock. So before we start our presentation, I'd like to walk you through our disclosures that are on this page. Option trading does have risks, and this webinar is for educational purposes only and is not recommendation or personalized investment advice. And to point you to the fourth bullet point, options do carry a high level of risk and are not suitable for all levels of all investors. Certain requirements must be met to trade options through Regal or any of our divisions. Please read the options disclosure document titled Characteristics and Risks of Standardized Options before considering any options transaction. And we do have on the screen a link, or you can send an email and get a copy of that booklet. So I'd like to turn your attention to our speaker now, Teddy Kestadt. He's done many webinars for us, and we'd like to welcome him back today. Teddy's a professional trader and has over 30 years of trading experience. He traded on the Chicago Board Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked and is the author of High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University as well. So without further ado, I'll turn it over to Teddy Kestadt now. Thank you.
Thank you, Gina, and thank you, everybody, for coming to join us for this webinar today. Real quickly, just to show you my disclaimer from my company. For every time I do a webinar, I always make sure it gets posted. It's the same thing as what Gina just put up for eOption. All right, so get ready, all you bulls and bears out there. Let's get into the meat and potatoes of what we want to get talked about. All right. So we have the eOption paper trading platform pulled up for you right now. It's the same thing as the regular platform, except this is in demo mode. And there's one way you can do that is by going to the eOption website. Is you can open up a demo account, and it will be exactly like this. I want to just show you a couple things on this account platform that we're going to use today. Alerts is something that would be valuable to a lot of you traders out there and investors. Open an account, obviously, would be where you start. But options play, this is something that you would, when you get this platform, should you decide to use it and learn more about options, contact the folks at eoption.com about how to use options play. It'll be a really good tool for you to beginner through advanced options trader to figure out different scenarios and strategies that you may want to do. There's a screener and there's a couple other things on here that we're not going to get to, but we are going to use the positions and orders, the trading, the options chain, and also the daily outlook. We're going to start with the daily outlook to pick a stock or two from this little list. Sector news breakdown. In the consumer sector, we have Chipotle Mexican Grill. I think a lot of you are familiar with that. We have Mattel. Any of you that have children or have been a child probably are familiar with Mattel. Skechers, Hilton, Wyndham. We're going to take a look at some of these stocks and see how they're behaving and see what kind of action we could actually look for in the future. Now, one of the things you want to be aware of is we do have a Federal Reserve meeting coming up in the next next week, actually, on Wednesday. It's a 2-day meeting, Tuesday and Wednesday. So this is probably going to have a big impact on a lot of what's going on with the marketplace. We have obviously the expectations that there's going to be a 3/4 point raise, and that probably will bring in a lot of volatility going up into that meeting and then after that meeting. So what we're going to look at today is just puts and calls for buy and sell scenarios. And we're going to look at from both sides, as well as the risk, whether they're even worth taking it. Sometimes, you know, there's a trade setup that's there, but when you look at the option pricing and what you're trying to gain on it, the trade is just not worth it. So that's something that's very important as a trader, no matter whether you're trading stocks, options, any other markets. Always know, have a trading plan. You know, trading is a business, treat it as such. Have a target, know your risk, and understand what is going on in the market behavior. Another thing is typically trade with the trend, or be aware if you're not, because that's something that's going to be important when we weigh our risks. Okay, so now let's get to a chart here. All right, so let's see, we had Chipotle. We don't need to look at IMB. So CMG, let's take a look at what this stock is doing. All right, CMG here is Chipotle Mexican Grill. Okay, so as we can see, since the middle of July, the stock has been basically trending higher. So on a daily basis and on a weekly basis, we can see that if we go back over the course of the last 1.5 years, it's been in a really wide range trade here. So that's not really helpful through there. It's kind of a neutral trade. So on a daily, we come back to here and we see that in the short run, it's been trending lower. Okay, so we know that the broad market's been obviously very volatile the last couple of weeks, and with the expectations of the Fed. So even though this market has been range trading, perhaps there's a couple of different options that we can take a look at. Now, for instance, if this is just a correction in the market right now for Chipotle, then putting on a call position in front of the Fed meeting might be a good idea. It may not be a good idea. One of the things that a lot of people might think is that, you know, if we know that they're going to raise rates, shouldn't that affect the overall stock market? Wouldn't it make it go down? So maybe that's a situation where you want to look at a put scenario, you know. So remember, this webinar we're going to show you how to weigh your options in both long and short positions here. We're not trying to guide you to what to do to trade into the Fed meeting, that is for sure. Volatility is something that we can really expect though. But we want to find levels. We want to find ideas, have an idea of what could go on with these stocks. So with Chipotle that we're looking at right now, I have two little indicators here. It's called a super trend. There's all kinds of indicators out there. There's no reason to really get into it. It's really like a moving average. It looks kind of fancy because of the colors and the shading. But this is really to kind of give you an idea of what's going on with the market. So there are two different variable settings for this indicator. So one's a little faster, one's a little slower. So, but typically when I use this is that, as you can see, when the market's correcting either to the downside or going to the upside, it's shaded. You know, when it's green, it's going up, and when it's down, it's going red. Now, typically when you have both of one color going on, it's pretty positive what's going on in the trend. Obviously, on the set for the daily, and that helps to give you an influence on where the trend may be going continuously moving forward. Now, since we're looking at the Fed meeting, we're looking at short-term options. We're looking at options that expire sometime between the next 25 and 35 to 40 days, because we're looking to take advantage of current market volatility and the Federal Reserve meeting coming up next week. So, and we'll see. Now, remember, sometimes you may own these stocks, maybe you don't. We're talking about how to put on call and put situations for these stocks. And some of these positions could also benefit those who actually are long the stock, especially if you put on a short-term put position. Okay, so real quick review. Double reds means bearish, double greens is bullish. So right now you can see on a daily basis that we have Chipotle that's kind of bullish. So let's go back to our trading platform here, and let's go to the options chain. Okay, so we're going to pull up this This is a great source of information. Now we're going to look, remember, we wanted to find out what's our expiration. Okay, so we have a November 23rd, 23 days to expiration. This is perfect right now. This is absolutely perfect for what we're looking at. So 25 days out, let's see, what was the date on that? Again, that was November 23rd. So I'm going to show you how far out this goes. All right, so November 23rd would be out here for expiration, okay? And then we have the Fed meeting, which is on November the 2nd. So between now and these 2 dates, we have final expiration, and then we also have the potential for a breakout one way or the other, especially because there'll be another Fed meeting in December. And whatever influence we have on that, the expectations will probably build and continue once again. So volatility is the one thing that we should get, whether it's either the downside or the upside. Okay, so now we have our 2 dates. So we go back to our options chain. Whoops, let's go, what's the price at right now? So we're at 1500. Okay, so let's go to, oops, got the wrong one here, CMG. CMG, got to put the stock in there. Okay, so once again, we're pulling up the options, and let's see, all expiration, November, we want those. Okay, there we go. All right. So we have the CMG options chain here, and now we are looking at the November 23rd. So we know that the market's right around 1500. Let's look at the pricing of these options. Now, because this stock is so expensive, and this is why we get into weighing risk, when we're going to look at multiple stocks here, we have to look at what's the value here. So 1500 right here, if you look at the bid and the ask right now here, we're looking at $55.10. So that means each of these options cost $5,510 basically to get in, depending on when you put the order in, what the market volatility is, give or take a couple price increments. So this is a very expensive option. So even though this is on our list from our account summary, remember, is for active markets, from a daily outlook we had for movers and shakers and the sector buildup, this is just too expensive, and with as far as the premium for the options, because there's not much time left. If this market just was to go nowhere to begin with, or definitely if it goes against you right away, you're burning through the money very quickly. So there's not a lot of gain. You would need a supersized move to make it worth your while. It's just too expensive of an option. So for that, CMG, we don't want to take any look at that. So we found out through the use of the option chains right there. Now, if you were expecting a major move, then perhaps it would be good. But for a $5,000 option plus that has only 25 days to expiration, you're looking at basically every day going, and you'll lose $1,000 just in time decay alone over the next week and a half or so. So that you would need to have a $10 move right off the bat, which at these levels, a $10 move is not that hard to generate. You know, you look at it, if it's trading at 1500, I mean, the range today alone was, you have a high of 1,558 and change, and a low of 1,495. So you have a $60 move. So yes, there is the potential to get some of that time decay, you know, eradicated with you, against you, or not, but it's just not, you still need a lot of movement, and that's something we don't want to put you into. So let's take a look at Mattel. Let's look at something a little closer to home. All right, Mattel has a very big move today. Look at how up and down it was today. So a lot of volatility. The trend is definitely lower here. Let's take a look at what the options chain is in Mattel. So now we go back to our option chain here, and let's see if we can find a put and a call position to put on with this one. All right, November 23rd, 23 days to expiration. Regular options, we want to put the November. This is it. Now we pull it up. All right. So what is the market trading at? We're at 1965. So right around $20. So 1950. So look at this. We have the 1950 option. Now here's something. You have the bid size, the bid and the ask here. You're at $1 to 90 cents. Okay, so that's not bad. These are actually very cheap options. Okay, so now cheap doesn't mean necessarily that that's going to be a good thing, but we're finding out that this is much better potential bang for your buck than what you had on the other one. So 1950, then we look over here for the bid and the ask, we have 70 cents at 80 cents. So here we have, so these are very, 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 very cheap, because when you add out, remember option pricing, you add $10, you multiply by 10 for the pricing. So these right here, let's take a look. Is it worth Mattel? Now we know that obviously, look at today, Mattel had earnings that came out. It opened significantly lower on the lower end of its trend. It made a lower low, and now boom, it's all the way back to where it's at right now. So on the trend, this thing had been in negative. See how we the double red here? But today, or actually not today, a couple of weeks ago, we spiked up here and touched off one of the super trend indicators. Not meaning that it's bullish, but definitely looking like it wants to go neutral. And especially with this market environment, volatility, I mean, look at what it had today. I think we might have a mover here. So let's take a look at what this could possibly do for us as far as strike prices. So we know that there's a 1950, oops, let me get the right horizontal line. So we know that there's a 1950 strike price. Let me just make this coordinates. Okay, so 1950. So here's where the market's just a little bit above it right now. So for calls or for puts right now is pretty much at the money where we're at. It's just a little bit in the money, at the money for the calls, because you're literally bouncing right around there for the bid and the ask on the stock. Okay, so we have our strike price now. We looked at the pricing there. Now let's see what kind of a move we're looking for. Now we know that we have the Fed meeting once again, and we have expiration on the 23rd. And we have the November 2nd Fed meeting. So we'll just look at the volatility we had here. We were down at just below, let's see, the low of today was just above $18. The high is just above $20. That's a $2 move. Okay, so that's a $200 move as far as option pricing though. Okay, so remember, for every dollar you have in option movement, that's 10, that's $100. So when you go from 20 to 21, that's $100 that you would be making on your options. So since we have already a neutral signal and we planted a lower move low, now the trend is definitely bearish. Now Mattel, if you think that these earnings are good, and the news obviously that came out made some people happy considering how negative it was in the very beginning, then maybe there's something to shoot for there. So let's see if you did that. So if we follow the trend here, we need a breakout, which we've already technically done. If you go off this last swing high to the recent swing high that was a week and a half ago, yesterday and the day before, we were kind of buffering up against this spot here. Today, we broke all the way down here and came all the way back up, and we're trending right here. So this is a good indication there's a potential for a breakout right here. So this spot right here, where we're right where the market's trading at right now, is a very good median, obviously. So this is our good strike price. So let's look at we're going to get to put the trade on here. So for a bullish play for the 1950 call, so we're going to go with Mattel, November 23rd. So we're going to go to our trading, and now we go down here to Mattel. Oops, not P Mattel. Mattel. All right. All right, so we pull up the option right there. Now we're going to go into, we want to buy a, where is long? Where's the cut? No, we don't want that. Okay, option, buy to open, quantity 1, expiration is November. Let me double check that. The strike price is 1950. And I call. Okay, so you can see once again here, we have the symbol here, Mattel. Under option, we have buy to open because we're buying the option. We're not selling, though. It'll be being naked the option. You don't want to do that. Not unless you're a very advanced trader. Quantity is 1, expiration is November 22nd of 22, and that would be the later ones. That's the 23rd, or actually it's November 25th for this one. Oh, it's a weekly. Let me get it right back here. There we go. Okay, strike price. Sorry about that, folks. 1950 and call. Okay. So we have the price in there. So the bid and the ask here is at 120. So market's at what you pay for the ask because you are buying that. So to put it on here, you verify the trade. Once again, to make sure that you are correct, you check it out. You have the estimated cost, which is $130, big difference than the first example we looked at. Then we have the commission per trade that you have to pay for the OCC and whatever, those are required fees. Estimated net cost, you push the trade button and boom, order is executed, it is filled, and it says here, the price here, the change, and blah, 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 you were done, your trade is complete. So now you can go to your account summary and you can see that under positions here, we now are long one call for the 1950 strike price. Okay, so and we paid $1.30, which is $130 to purchase the option. Obviously, market value now is 125. It's because you buy the ask and sell the bid. So if you were to get out of it, you know, and the market's where it's at now or lower, it's a little bit of a loss on that. A little bit higher, you'd be scratched to a little bit positive. So now we can see that right now we put on a call right here. And then let's look at how far the value what we're looking for here. So we already know that we put on the call. Now, whether we're right or wrong, time remains to be seen. We know that it expires here on the 23rd of November, and we know that next week we have the big Fed meeting. Okay, so as far as direction, let's just say hypothetically that we are right on this. So we're going to use old Fibonacci here and get the old 50% numbers. Now, 50% is an old trader's target number, okay, for corrections. Does it mean that the market's always going to hit that number? No, sometimes it falls short of it. Sometimes it goes above it. A lot of times it does hit it, but it's a target area. So if let's just say that Mattel is going to remain in a bear market, okay, it's because it's been trending lower. Okay, but doesn't mean that it can't have a correction right now, especially with the way it came back today. I mean, you had more market action on today's trading than you had in the last month and a half. If you look at the range here, you absorb all the trading that we've had since going back into September. That was the last time that we were in this, where we set this range. Okay, so we take that away, and I'll actually put one more number in here as an extreme, and then a little one here as a minor. Okay, so we use the Fibonacci here to figure out some levels. This one here, the middle one, is the 50% level that I was talking about. So we'll give that the orange color. All right, so we have this area here, this area here, and this area here. So we had bought the 1950 call. So let's say that it actually goes to just the minimal right here of 2042. All right, and let's say that it's sometime between here. We know that at expiration, it's over. Okay, so let's make this a little bit smaller. Okay, there we go. All right, so if it happens sometime between the Fed meeting and expiration and it gets to 2038, you're going to have a little bit of time decay on it, but you'd be almost up a buck. So what did we pay for this option? Remember, we paid $130 for the price of this option. So if it only corrects up to this one little area here, and that's the extent of it, now that's right around where these highs were, you're going to probably see some resistance. If the market's going to fall apart, this would be about the extent of where it would go. That could be your problem level. If it gets above here, well, then it takes out this high, which is very bullish. That would also trigger this other indicator. So that would be in a bullish thing. Not that these indicators are always correct or anything, but that would be a bullish sign. And then that would lift it up towards here. Now, what happens if it gets to 121.06? Okay, so you have a 19.5, excuse me, call that you purchased for $130. Okay, so remember it's $1.30 here, market value 125. So, whoops, we don't want to do that. We just go to here. All right. So if we're at 19.5, right, or right now at 1964, so that would basically be $1.50. That's $150. So let's see, let's do the math here. If you get a correction up to this area, maybe it even happens next week before the Fed meeting. If it gets up to there, then you would have $150 in premium in the price of this call option that you just purchased. So I don't know if that confuses anybody, please ask a question in the question and answer box, because that's very important to understand when we get to understand the risk and the reward of what we're looking at for a trade. So just that move alone would pay for the whole price plus what you paid for the option. Anything left in time value, now we know that time value, there's not much left in this option. That's why we're going so short. We're looking for just a move that goes into the Fed meeting, whether it's long or short. Okay, now to the buy side, that's a good value right there. So, I mean, because you're paying 130 right here, you already know that you have more than 1-to-1 profit ratio on a very reasonable upside target. Okay, and before the Fed meeting, usually it's like very likely that markets go sideways, like from the Tuesday into the Wednesday number. Not that it's going to happen, but it could happen. It's very likely. That may be a time where this option be something, if it's already up to this area and the options, let's say 150, 175, close to 200, you could already get out of it. I mean, if you made, let's say you made 30, 40, 50% on your money in 2-3 trading sessions, I don't know about you, but you're not getting 20, 30, 40% in most investments anywhere in a couple of days, you know? So is there more potential on the upside? Absolutely. Let's just say that we get up to, now this was the 50% line. This is just, let's say it's just a correction. Okay, let's say it's an irrational, exuberant correction, and it gets up to 21.79. Well, now we're looking at over $2 in premium. That's $200 for the option for that you paid 130. So no matter what, you get all your money plus that, you're making up almost 50% return on your money. So if this doesn't make any sense or is confusing to those who are beginning options trader, please let me know, and we will definitely go over it. So right now on a price point, we just found out that for Mattel, at least on a call, we have a pretty viable reason to be bullish here and not necessarily so bearish. This is a counter trend trade. That's why we're looking at this as a correction. We're not looking at this as a long-term bull for Mattel because of whatever earnings news came out today or what's going on in the marketplace. Remember, we're looking at recession fears, which obviously Mattel is a toy company that which probably I would think have something of an issue when it comes to their numbers potentially, but they're also coming into the holiday season. You know, I mean, no matter what, parents may be tightening their belt on their spending, but when it comes time to the holidays with the kids, you know, I would think that there's a lot of people that are going to be like, okay, well, we'll just not go out as much and we'll make sure that little, you know, Susie or Joey gets their Christmas gift. Very big for a company like Mattel. So, okay, so now let's move on to another example here. So we had a good example of Mattel. So we're going to pull up our option chain again and start looking for another option trade. Or we could put on a put real quick. You know what? Let's see what the put example is here and look for the upside and downside potential. So on a daily, we see how we've been moving. Okay, so we know that the trend here was up for a long time. On the monthly, it's definitely still a bull. So this market, maybe it's finding support and getting ready to go back up, or maybe this stock's not doing so well and it's going to come back down to its lows here. So let's just say you're like, Teddy, you know what? I think that the Fed's going to raise rates. Well, all of us are pretty much on that page. And you're going to say, you know what, Teddy, I think the market's going lower. So let's see, what's your potential on that one? All right. So the one thing we know for sure is that with calls, you have unlimited upside potential. I mean, the stock can theoretically go to infinity. I don't know how you get paid on that one, but it can go up. To the downside of put, it can only go to zero. That's for sure. Stocks can't go negative. Oil obviously can. We learned that one during the COVID V-shaped trading of the markets. That was pretty interesting, right? All right, so put. Okay, so let's just say we go with the 1950 put. Now we knew that one here on the options chain for Mattel, the 1950 put is right. The pricing here, oops, there it is, 1950 is at 70 at 80. So that's pretty decent bid ask right there. That's not too bad. All right, so let's say that the put side is the way you want to go. And you're like, forget it. Fed's going to raise rates the next 2 meetings. That's right here in November. And then again here in December. overall market's looking kind of weak, all kinds of economic numbers that are just not looking great. Maybe you're thinking, oh, you know what, Mattel, if I like it at 19.50, I'm going to like it even better at 15 bucks. Okay. So knowing that we already have a neutralized indicator here, but you're bearish, where can it go? All right, well, let's say we get a target on here. Let's put on a trade here. So if we go back to trading over here, and now we're going to go to buy to open, and we're going to change this to a put. Okay. And we want the 19.50 strike price. Okay. So now we want to look at this 70 at 80. This is cheap. It costs $7 to $8 to put this one on. This is where it gets, you know, I mean, why not? You know, this is almost like a lottery ticket on this one. But remember, for our analysis, it's more likely to go up, at least in the short run, than down. But let's see what happens with this pricing. Why not check it out? All right, buy to open one contract of Mattel, November 2022, 1950 put. Okay, we have an estimated cost of $85. That's next to nothing. Let's see, we have our option, your fees that you have to pay no matter what for the industry fees. Net cost, put the trade on, and shabam, get filled at the price of 80. Okay, so now we go and check out our account summary. All right, so we have our call and our put position that is now in here, and we can see the price, average open price is 85. Okay, so you multiply times, not times 10, times 100, excuse me, and that's $85. That's what we paid. So we paid 85 for the put and 130 for the call. Okay, so right now we go back to the chart and we know that we have a neutral to potentially bullish breakout happening here. If it does happen, we have some target areas. Now we know that in order to go for the downside, if we're at 1960 trading right now, if you get down to 1850 at least, or something like that, then you're already going to be pretty much breaking even on this contract. So let's just say that we go for the low. So today we set a new low right down here, right around 1808. Okay, so that's $1.50 move right now. If we were to go back to those lows, like let's say that, you know, today was an irrational trade, the market ran it back all the way up to where it was trading yesterday or close to it, still lower on the day, you know, and when we looked at the monthly, yeah, it could be bearish. So let's just say the bearish scenario is the way to go, okay? And resistance keeps this market suppressed, and we go to make newer move lows. Remember that the trend has been, here's a lower move high, a lower move low, lower move high. We just made a lower move low, and now technically today we made a lower move high. So you can even use this, you know, if you go down to the hourly basis, this is right here. You know, I mean, we can go here, show you hourly. See where it, boom, there's the spike. This is, the market opened up down here, whoosh, boom, like a balloon underwater rally, found resistance here. This could be the lower move high before the market goes lower. So remember, once again, we do these webinars here. This is not, we're not telling you to buy calls or puts here. We're giving you the scenarios. So right there, to the downside, there may be a lot more potential on this put. First of all, the premium was too much cheaper. Obviously they're leaning more on the buy side than the sell side with this. So that means the option price was better. Now also you paid less than, you paid a 130 for the call, you paid 85 for the put. If we get down to 1808, which would be $1, there'll be over $1.50 move. That's 150 in premium for the option that would be added to the value of the put minus time value. So let's do the math. $150 of premium made on something that you paid 85 for. That's nearly, I mean, that's over 90% return in a period of, well, we'll see, have to see how many sessions that would be. If the market was to come down into this area here, even below over here, somewhere below 18 into the 1750 area or something like that, where you catch a $2 move, you're making 200 on something you paid 85 for, you know? So that is where there's definitely more bang for your buck on the put scenario, however, the odds of that trade happening right now are, I mean, the overall trend has it set up to do so. Is it going to happen in this very short time frame with this with the time of expiration so short? Maybe, maybe not, especially with the way it bounced off of this. If this market goes sideways, it has probably a better chance of flirting again with these highs and breaking out to the upside a little bit. For like, and remember this 50% area, this could really be the place where it stops this rally. Okay. And that's still your put value. You're going to have zero, basically next to zero left on your put value. And then you're going to need an extensive sell-off just to get it down to become even remotely profitable or even break even, you know, because you still have $85. So you have to get from, we opened it at basically 1960. So you got to get down to like 1890, 1870, which would put you down towards the lower end of this range. So if any of this doesn't make sense, please ask a question on the Q&A. Let's see, we have, let's see, this, that. Okay, now let's go back to over here. All right, so now let's look at the next option. So we're going to pull up our option chain here, and why don't we go to Skechers? Everyone's familiar with Skechers. I don't know if all of you have used their products. I remember years ago, I was like, oh, this is probably ridiculous. This is just for kids. But then I had a pair and was really surprised how comfortable they were. So, all right, we have regular, we have all, we have 23 days to expiration. All right. So let's look at this here. We have Skechers pulled up, the option chain's going on. Now we go to SKX here, SKX. All right, now here's another stock here that had been, just looks a lot like Mattel. It's probably because they're both in the retail sector to some degree. Well, obviously they're both, I mean, in very different degrees, excuse me. But this one here, you have, it had gone into a buy signal. Now it triggered a little sell signal. The overall trend is neutral. This thing, maybe it's a bear. Let's see what it looks like on the monthly. Okay, big sideways, but over the course of from last year, from summertime of last year all the way into now, it's been basically trending lower, but it's coming off a higher move high, hopefully maybe setting a lower or higher move low last month. That remains to be seen, but obviously Skechers is not doing so hot as they have in the past. All right, this gives us a good chance for at least some volatility. We can see that just in the past week, we're trading now at $33.50. It was around 30, almost at $37 just a week and a half ago, and also down to $31.30. So it's had some nice volatility, and we're right in the middle of it. So let's take a look at this SKX. We got the markets at $33.50. So let's see if there's a $33.50 or a 33 even. 33, here we go. All right, we found 33. We have a bid, let's see, of 185 and $2 on the call side, and on the put side we have 115 at 130. So that is you have 150, 130, same price as the other option for the put, and then 200 for the calls. A little bit more expensive options for Skechers than with Mattel, but then also the pricing is a little bit higher also. So, and also it looks like the volatility is a little bit there too. So now we have, let's see what kind of action we have for that. So we've figured out our strike price at 33, and we know that we have some decent pricing. And one of the big things is, remember when we did the last example versus when we first, we looked at Chipotle, the options were so expensive, and the move that you really needed to get was just besides being very risky, your reward to risk ratio diminished very quickly, and there wasn't a lot of potential. Now with the last trade and even this one, if your move doesn't totally happen, you still have a chance to break even or even pull a little profit out of this without having a full move occur. Remember that once you get into a trade, you don't need to get married to it. You can make sure you have a target, you know, your risk and things like that, but it doesn't mean that, you know, I mean, next week the Fed could come out and do it and the market actually falls asleep and goes nowhere, and you're like, hey, I can still get half my money back, you know, and I'd rather do that than see if I end up taking a zero loss on it, you know. So if there's for instance, it could be a non-event with the Fed meeting. I don't think that will happen, but it could happen. All right, so Skechers here, we have our 33 level strike price. All right, so let's go and see what the pricing is and the trades are going to be like. So let's just say we use, once again, good old Fibonacci to see if we've had, now we already had a correction up to 50%, just beyond it. See how this 50% level works here? This was a correction up here, that level worked. Just a little bit higher, it didn't make it up to the 0.618. But if we're going to turn around, then obviously if it breaches this area here, makes a higher move high, we have a really good chance at getting up to 37.67. This is if the bullish scenario was to arrive and occur. We can see that there's a little bit of downward. Now you can see from today's trading that we were wedging into today. And now look at this, look at where we're at here. Maybe the put scenario is the way to go instead of the call scenario. Okay, so remember the trend is overall bearish, and there we go, a little clearer now. Okay, so you can see the market was wedging, it broke out to the downside, it made a lower move low after a lower move high. So the trend is consecutive lower move highs, lower move lows, it's bearish. The put side is probably the way to go for this trade. Maybe could also be the call side. So we're going to figure this out. Where's the risk reward potential on it? Well, we can see that for the calls and the puts, the put definitely seems to have a lot of action and potential. For the calls, you're taking a counter trend trade. And in front of a Fed meeting where you know that they're going to most likely raise the rate 3/4 of a point, which will probably be negative for the market. So you're taking a counter trend trade in a downward trending influence market. Calls very risky trade. The put, let's take a look at the price. So 33, we go to our trading, and now we change the symbol to SKX. We put that in. And then we add option, we go into buy to open because we are buying. Remember, quantity is 1. Expiration, we're going to go with the late November. Oops. Go with the November 25th. Oh, wait, not November. Let's go with this one here. 1/4. Strike price is 33. And we're going to look at the put first. So the bid is 120, the ask is 135. So to buy the put, you're paying 135. We verify, you can see 135, your commission structure right there. Boom, we hit the trade and it is filled. Now we go to our account summary, excuse me, and you can see that average price to open was $1.35 or $135. Now you can see what the market value is. And you can see the percentage change. And now we have this position on. Now we know what we paid. We paid $135. How far do we got to go? So $135. So let's just round it. We're up trading at 33.49. So basically, if you get down to 32 even, you're breaking even. Okay, that's what you'd have to be at below that area to break even on this contract at expiration. So we get down to, let's make it really easy here. So we're at 33.45. So yeah, basically 32 was put there, 31.97. That's not a big break to go. I mean, if you look at it, we just made a lower move high. If we go to take out this low that we had set back at the end of September, and the trend has you eyeballing that, then it is very likely that we could hit this level before expiration comes, you know. Or you maybe even not just before expiration, it could happen over the next week going into the Fed meeting, especially, excuse me, if yields start to go higher in a big way, pressing the trade in front of the Fed meeting, that would probably weaken the stock market, or at least have them going sideways for at least a couple of days going into that meeting. So that would be something you need to pay attention to. Once again, giving a little credence to why you might want to put a put position on here. Also, there's not much of a move it needs to do to get to the break-even point. If it goes even further, and we could see already from the monthly that this market has been trending sideways, but you don't want to try and pick a low. You know, I mean, last month did it bottom? It did short term on a daily basis, but on a monthly basis, it set a new low last month. We're coming off it a little bit. It could easily come back and come through support a lot more yet. So we don't know, and we're not looking at a long-term trade, remember, because of the short-term expiration. You know, it may go down there, but it may take 2 months, 3 months to get there. Well, that doesn't help us. So right now we know at least if we get a slide below 31.35, you're going to be in the money more than just the option, because whatever we have time left and a couple in the volatility premium, you'll be in a plus. And you got to figure that you don't want to try and pick new lows, but I would assume that if you do take out the lows, you can see that when it goes down by this here, the market was at 33.43, it got down to 31.23, so a $2 move. So let's just say you get down to 29.33, so just like you get down to 30 even. Well, from 30 even to 33, that's 300. So let's go back to our eOption. You paid what? 135. So if you get a slide and make new lows like that, that's a great return. You're making 200% return on your investment. Not bad, you know. So this is something to think about as far as for that kind of trade and with that kind of methodology. When you have a stock like this that obviously today it didn't react like the Mattel did off of earnings and things like that. So, but you know, it definitely had some volatility, and the trend is your friend. So the put scenario is the way to go. Now we still can look at the call scenario. Let's see what it looks like on the call side. Let's say you're a bull and you're like, Teddy, you know what? I think that Skechers, they have a shot. You know, they definitely have a shot. So let's go to buy to open here. We're going to go to the call and see what that's at. So that's 175 at 190. So that's 190. So it'll cost just under 200. All right, let's verify that trade, 190. Let's get it isolated and now see what would happen with that one. So just to make sure, we go to account summary. So now we have a call in Skechers, and as you can see, market value, we paid 190. So let's go back to our trade here. So 190. So if we paid 190, we need a $2 move to break even, basically. So let's go to before expiration. So let's go to, here's our call. We had $2 move. We're at 33 halves. We got to go to 35 half. So 35, and let's move this to. So if we get above 35.50, excuse me, no matter where, or above 35.50 with the call at expiration, you will be at break even. So you get your money back. Now, is it possible that we get up there? Well, absolutely. It's totally possible that we can get up there. Now, remember, when we use that rule of 50% for the Fibonacci, and I pointed out that it had already hit right at the 50% line. So 50% is this 36.38. Okay, so now let's just say that this market is stabilizing and it made a higher move low today. Let's just say that this little marker here today is a stamp. All of a sudden, we're going to get a little leg up, a little support. Got to give a reason to, you know, every once in a while to the bulls, right? So the market was wedging, it came down. It's almost unchanged on the day. If it was to rally back into this wedge up here, well, obviously for the call position, you would be doing well. 35.50 is your break-even number. Now, we have this downward sloping resistance here, keeping the trend intact. If we get back up here and rally, take out this line here, this high right over here, just above 36.38, right around 36.90, 37 even, that's a very reachable number. Now, think about that. You're at 33.48. If you get all the way up to 33.44, okay, 36.44, you're catching a $3 move. That's a $300. That's $300 in value. You paid 182. So on this one, you wouldn't have the highest potential for as far as a target, because remember, this market's in a bear trend. Obviously, this market could easily, is not out of line, that Skechers over the next week and a half, it could shoot up to $42. It can go up to $50. But just technically and fundamentally with everything that's going on, those expectations are not there. I'm not saying it couldn't happen, but it's very unlikely. But reaching these areas is very possible. And as far as if you think about it, in the time frame, you're looking at less than a month and a half of potential trading. You have 4 weeks. So you have the rest of this week, and then you would have 3.5 weeks of trading in November, right in front of Thanksgiving. So a little over 4 weeks of action for you to capitalize on this move. we have the Fed meeting. After that, the markets may cut loose. Remember, usually after a Fed meeting, we have a lot of volatility, and then you're going to have either a counter trend or a resumption of the trend and have a good leg of action, basically getting where volatility takes you at least 5 to 10% away from where you were in a lot of stocks. And that's what we're looking for on these moves, whether you're being bullish or whether you're being bearish on this. So let me see if we have questions here. We have some stuff here. I don't know if I'm getting the right chat box here. All right, here's the questions here. Answered, dismissed, open, no open questions. Okay, you guys are either you guys are very quiet today, or I'm just not getting the chat right. That could be very possible. I had some issues with with this before. So since I don't have any questions here, and we only have a little less than 10 minutes left, we're going to go over a little bit of a review about what we were looking at. So once again, we had, now I used the super trend indicators. Remember, there was two red, as you can see these lines here, or 2 green here, sets the trend for either bullish or bearish. You can use whatever indicators you want. I do suggest that if you do use indicators, remember, 1, that they are always lagging, and number 2, to use usually 2 or 3 to basically coincide with each other or confirm each other, if you will, because if you're just relying on one indicator, there's lots of filters that are needed. It's a whole webinar in itself. Keep it simple. I use this indicator here, excuse me, just to give us a bias for direction. We know that with this example with Skechers, it was put into neutral. It had been a bear. We identified the trend. That's why we look at the put being like, overall, if this market's going to continue to behave the way it has been behaving, the downside does have a very viable targeting area that's not that extreme. And even just to get back down to its lows, I mean, remember 31.97, if it gets to this area, that is, oh, we do have a question. There we go. All right, nice. All right. All right, Nim, is eOption available in Canada? That's a question. That's a question you need to ask them as far as how they can cross borders and that. I know that some foreign entities are allowed to trade through U.S. corporations, but it's how you're set up and things like that. I cannot answer that question for you. But I know that the people at eOption for sure can answer that question for you. So good question. So once again, just to get a little review of what we've been going on here, we know that I use these indicators. Once again, I gave you a little scenario as far as which ones you can use. The 50% rule for Fibonacci. Remember, trade with the trend. That's the best thing I can say. Like, for instance, we know that Skechers has been basically neutral to lower. So when, for instance, here, once it goes from double green to double red, great time to look for a put position. Great time to look to sit. Now, I would never short stock. That's what puts are for. Shorting stock is a whole different dynamic that's a whole webinar in itself. But great time to exercise puts. So like today, we're in neutral territory coming into a Fed meeting where we have a lot of indecision. We're not trying to put a line in the sand or take a position here. That's not what this webinar is about. We evaluated the risk on both sides with basic calls and puts, showing how in the short term into the Fed meeting, how you can take advantage of this, especially when we have pricing like we found. The 2 markets we looked at, very good pricing. The very first one, Chipotle, very common company. Everyone's familiar with it. Guess what? That trade probably would not have been a good idea. Now, this one here, for instance, when we had the double reds here, and this got triggered here, and we started to go trending lower, this would have been a great time to put on a put position. So the opposite is here, when the market went from red, hit a green, hit another green trigger, all of a sudden it's stabilizing. The market may not necessarily be bullish, but it sets you up for a correction. We're trading in the same area right here as it was when this market turned with these greens. Now, once again, I'm not telling you to start using the super trend indicator. If you do want to learn how to use it, though, contact eOption. They can contact me. I can send you the information on how to set them up and what the rules are for it. So, but this would be a situation where you would look to put on a call position. So basically, the 33 half call position that we put on, or actually we put on a 33 even, excuse me, position that we put on here, we would have been going out to November, because with this time, if for this type of trade, you wouldn't be looking for just like a 15 to 25, 30 days. You would be looking to go 35 to 45 days out, just to give you a chance to get at least 2 to 3, upwards of 4 weeks of trading to give you opportunity. This would be a situation where call play would have been fantastic. We wouldn't even look at puts. I mean, the trend would be lower, but for this, if you're just trading the indicators, that's where that would help you to define when you want to put in puts, when you want to put in calls. Like I said, my indicator setup here is what I use here with all types of different things. For instance, here, Fibonacci, it had you exercise bought in an option here, which is basically the same market area as it is now, same type of option. You would have gotten all the way up to the 50% mark. The market's an overall bear. You know that we got to that. Remember I said when we were evaluating this, get to your target level, especially if you're in a counter trend trade, you get out, especially if you have a lot of time left before expiration still, because then you capitalize the whole move that had occurred from the time you got in to your target price, plus the volatility. The only thing you lose is time decay. Remember, when you're buying puts and calls or any options, you do lose time decay. The good thing is that these options are so short and till expiration, almost all the time decay is gone. There's not much left in the premium of the price of the option. It's more about the price differential between where the market price is and the strike price. So is it in the money, meaning above, at the money being right at the market price, or below being out of the money? So, and that's very key items to remember to pay attention to. Remember from your eOption that when you're looking at the things, use your option chain, check out the pricing first. Remember when we looked at Chipotle, very important, unless you have some super big expectations, you don't want to put in those, to buy those across the options. And I'm not steering you away saying don't ever buy Chipotle options. That is not at all what I'm trying to say to you whatsoever. But looking for trade scenarios like we are, you want the most bang for your buck, the biggest reward to risk ratio, and the highest potential of market movement in the short run, any or longer term, depending on the time frame you're looking at, that you can capitalize on. If you do that, I promise you that your trading results will be enhanced over however else you happen to be trading in the current whatever methodology you're using. And one of the reasons I emphasize these things is because it's all about money management. Money management is the key to successful trading. So with that, let's see if we have any more questions here. We have no more questions. So definitely appreciate that. Okay. So we're going to wrap things up right now. And just to remind you here real quick, I'm going to end this with a little bit of information. Please listen to what we got going on here. Some good things. More eOption resources for you. You have remember, you pay $0 for unlimited stock and ETF trades and 10 cents an option for 10 cents for option contracts. You have the powerful, intuitive trade platform and over $500 in free trading tools annually. Visit www.eoption.com for more option strategy resources on their website. They have all kinds of helpful information for new to experienced traders on all types of trading strategies, scenarios, and information on how to expand your knowledge in options trading. For more videos on options trading, subscribe to their YouTube channel at youtube.com/eoption. And there's a special promotion that they are going to be running for free stock for this video. So that's why I said, please listen to this. If you want to take advantage of some free stock from eOption, this video will be posted sometime, I think, within the next 24 to 48 hours. And the promotion will be on there. I know it's limited time. I don't know how long it is, but they will be running a promotion for all of you that watch the video. Click on the link, get the information, and there's the free stock offer for you from eoption.com. So, and also do like, share, and subscribe to their YouTube channel. It's growing in subscribership and also in content. You'll see some of my past videos are on there too, and future ones to come as well. So, and one last thing, I want to thank you all very much for your time today. It's spending your Wednesday afternoon with us. Mark your calendar for the eOption next webinar, How Dividends Can Affect Options, Wednesday, November 16th at 1 p.m. Central Standard Time. Register at www.eoption.com webinars. Thank you, everybody, very much. Once again, I'm Teddy Kestadt, and you guys have a great rest of your day.